Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about leases, why they're important, what they are, the different definitions that are involved in leasing, how we determine how a lessee and a lessor classify their lease. We've talked about all the different steps and journal entries that have to be done. We've done several examples, both of how to do a short-term lease, to do the longer-term leases for the lessees, financing and operating for the lessor, sales type and operating. We've talked about how we calculate the actual lease payment, and then we talked a little bit about IFRS as well. So we've covered a broad gamut of all the different topics that are involved in leasing, and this is still just the tip of the iceberg. There are so many different ways that we can structure a lease that we just don't have time to talk about them all. So what we've done is just summarize the most important concepts about leasing, and hopefully you're starting to feel pretty comfortable with it. What we want to do now as we wrap up our discussion of leases is one last comprehensive example, where instead of putting the different kinds of lessee or lessor accounting side by side, we show how a lessee and a lessor would record the journal entries. So with that said, let's jump right into our Sampson Iron Mill example. Sampson Iron Mills decided to lease a piece of equipment from SLC Leasing on March 30th of year 3, so a couple months into the year. The equipment has a market value of $100,000, was purchased by SLC for only $75,000, so now their market value and historical costs don't match up, which means that it's going to change some of our calculations with the initial direct costs for SLC. Estimated useful life of the equipment is 7 years, and then there'll be no salvage value at the end of that time. SLC and Sampson have decided on a lease term of 3 years. At that time, Sampson will have the option to purchase the lease for only $2,500, even though the estimated market value is $30,000. And we stop right there. That is a bargain purchase option. That the value is $30,000, but SLC is only going to require Sampson to pay $2,500. That's what makes it a BPO. And right there, it also makes it a financing lease for the lessee, Sampson, and a sales type lease for the lessor, SLC. Because one of the major determinants of classification is whether or not the lessee has an incentive to buy the asset or renew the lease. And in this case, a BPO is a significant incentive. Even if Sampson doesn't want to keep it, they can buy it for $2,500 and then sell it for $30,000 and recoup some of what they've paid to SLC. So they have an incentive to buy it. SLC's interest rate for lease will be 7% because Sampson doesn't have the best credit history. Sampson doesn't know that SLC is using 7%, so they'll use their own 8% internal interest rate. SLC spent approximately $1,500 initiating the lease. Sampson, since it has worse credit and doesn't do this on a regular basis, will have to spend about $5,000 on closing costs and other costs associated with the lease. Very first issue that we had to decide is how we're going to classify this. We already know what we're going to do that way, which brings us to step 1 for both the lessee and the lessor, and that is to figure out the amortization schedule. And in this case, I didn't tell you what the lessor was charging, which means we need to start with the lessor's amortization schedule and with the calculation of the lease payment. So here's our information: $100,000 market value, $2,500 residual value because I'm going to get the BPO amount. There's my interest rate and my N of 3. Let's figure out what my payments need to be. And for SLC, the primary goal is to make sure that I get my full $100,000. So I'm going to get some from the lease payments, and the rest I'm going to get when Sampson pays me $2,500 3 years from now. So the first thing I need to do is figure out what that $2,500 is worth today. So the present value of the BPO, or the residual if you just want to call it that, will be the $2,500 times the present value factor, 3 years at 7%. And we're not going to take time in this video to go ahead and look up table value. I assume most of you are using either Excel or a financial calculator. If you're not, you just go to your table, go across the 7% down to row 3, and that will give you your factor. But you should come up with something pretty close to $2,041, which means this part of the lease needs to provide me with the $100,000 fair value minus the $2,041. So SLC needs to make sure that they get $97,959 out of the lease payments. So that's the present value of the lease. So the present value of the lease has to equal the payments times the present value of an annuity due n at a given percentage. I know the present value of the lease, that's the $97,959. I'm looking for the payments. 3 at 7%. So my payments will be equal to 97,959 divided by that present value of an annuity due factor, 3 at 7%, for a grand total of $34,885. And now I can fill in these values. So if we come up here, the amount needed from the lease, that's this number, so 97,959. Now that I know that number, the next thing I need to know is the implicit interest rate. And to do that, I go back to Excel. You remember I had done this calculation before. Let's just replace these values with the values that I need. So market value is 100,000. In this case, I don't defer my initial direct costs. I have to record them immediately. So I'm going to go ahead and make this 0 this time. My payments, we said, were $34,885. Now I need to fix this part, and we're not doing this on January 1. We're doing it on March 30th. So let me replace that, and this would be year 4, the next year. And on March 30th of year 6, now I need to fix these amounts because I'm not getting $56,000. That was my other lease. $34,885 and $34,885. And this last payment will be $2,500 as I finish off my payments. So my equation is equals the IRR, internal rate of return. So just about that same 7% as I'm charging. And usually, if I get rid of those initial direct costs, it comes out to pretty darn close to the explicit interest rate that we charged when we set up the interest payment. So let's put that in here, 6.9983. And now I can do my calculation. So the present value of the $2,500 at the 6.9983 is a little bit different than what we did before, but not much. If we round to the nearest dollar, matter of fact, we don't even see the difference. It's too similar. And the present value of the leases comes out to be just about the same thing. Because really, this is almost 7%. So the only time you're going to see differences in these values from the values down here is when we include the initial direct costs in our IRR calculation. Now in this case, remember the lease receivable is everything that we're going to get from the lessee. So in this case, we're going to get the $97,959 and the $2,041 because they're going to pay us that bargain purchase option. The only time we don't include the present value of the residual value is if it's an unguaranteed amount. So if we add those up, well, look at that. It comes out exactly equal to the market value, and that's what we should see. I think the last thing we need to add here, I wrote the $34,885 down here and used it in my IRR calculation, but I didn't actually put it together. Now I'd like you to pause here and do an amortization schedule. You've got all the information that you need. That $100,000 will become the beginning balance of your lease receivable, and you've got your interest rate, the 6.9983, and you've got your payment amounts, including a final payment of $2,500. Pause it here and do the amortization schedule. Well, hopefully you got something that looks like this. Again, the $100,000 comes down. We have 3 payments of $34,885 and then $2,500 as a final payment. We end up with 0 as our balance, which is what we wanted. Our lessee is going to pay us $107,000 for this $100,000 worth of equipment. And again, that's pretty typical. Now, the last thing the lessor needs to do is they need to do that one last table for the unguaranteed residual. And then we can move on to the lessee's book. So here's our table for our unguaranteed residual asset. Now, we look at this every time, but in this case, there is no unguaranteed residual asset because I'm going to get $97,959 from the lease payments, and then the lessee is going to pay me the last $2,041 in present value terms, which means there's nothing unguaranteed. So this is going to be 0 all the way down. So I don't even have to worry about this when everything is guaranteed. The only time I'm going to see this is if the residual isn't guaranteed at all, or if they only guarantee part of what we think the salvage value is. Let's say we have a lease for $1 million. We think at the end of the lease period it'll be worth $300,000. The lessee says, I'm not guaranteeing $300,000, but I'll guarantee $150,000. I'd have another $150,000 or present value of $150,000 that I'd include here because part of the residual is guaranteed. And that happens sometimes as well. Now, the last thing we want to do in this video segment is look at the lessees table. So let's put in what we know. We know the payments. We just calculated them. $34,885. I know the market value is $100,000 and that I've agreed to pay $2,500. I know the interest rate that I'm going to use is 8% because I don't know the 7%. And I know the number of payments is 3. I also know that I'm going to have to shell out $5,000 to make this work. Now I'm going to calculate the present value of these numbers using my 8% interest. So the present value of the bargain purchase option or residual value that I've guaranteed would be the $2,500 times the present value factor, N of 3, 8%, and that comes out to $1,985. The present value of the $34,885 payments, present value of an annuity due, 3 payments at 8% is $97,094. And the lease liability will be the sum of these two, so that's going to be $99,079. And finally, the right of use asset will be the sum of these two values, so $104,079. At this point, I'm starting to wonder, was this such a great deal when I could have purchased this asset for $100,000? Why did I do this? Well, because I probably would have had to pay the $5,000 to get a mortgage or another kind of note anyway, in closing costs and legal fees, and they would have charged me the 8% interest instead of the 7% interest, so I would have ended up shelling out even more than just the $104,000. So now I'm ready to do my amortization schedule. I'm going to bring this number down, $99,079. Again, I'm going to have 3 payments of $34,885, one last payment of $2,500. Now, we're not going to walk through this together. Again, you can calculate an amortization schedule on your own. So take a few minutes, get that done, and then join me in the last segment where we'll start to do the best part, the journal entries. We'll see you then. Thanks.